It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal here is to help cut through that noise, to help navigate the best moves for your portfolio. Today, we're going to take a look at the most nutritious play when assessing protein-oriented consumers. And I'm here with John Baumgartner, Mizuho Managing Director and Senior Consumer Equity Research Analyst. John, good to see you. Josh. All right, so let's start with your first buy here, which is an interesting pick. And this one is BellRing. I'm going to walk through some of these reasons, John. So the first point here, take us through it. Protein nutrition category, growth potential, you say.
Yeah, so BellRing is the leader in the U.S. ready-to-drink protein shake category. It's a $6 billion market with a history of double-digit growth. We're seeing a significant shift in this category. Historically, it was mostly bodybuilders, athletes drinking this category. We've seen that shift now to more everyday consumers. We're now over half of the category. It's folks looking for a healthier breakfast, meal replacement option. So the category has legs on the volume side. More households, more consumption opportunities. We see a range of innovation coming over the next 3 to 5 years. More functional ingredients, more specialization that will maintain category growth ahead of the street expectations.
All right, it's not just bodybuilders anymore. That's the
right.
point. Second, leader in protein nutrition shakes. We got a chart here, John. Walk us through that point.
Sure. So as you can see, BellRing has been supply constrained on and off for the past couple of years. Right now, the company has more supply coming online. They're growing distribution 20%. Revenue is also up mid to high teens. There's more capacity coming online over the next 12 months that will continue to drive household penetration. To frame it for you, the category is in about half of households out there. BellRing is in about 15% of households. So there's quite a ways to go.
Potential long runway.
Exactly. Right.
Third bullet point here, let's wrap this up. Potential paths for upside in the stock. Walk us through it, John.
Sure, so there's a couple. So organically, again, more supply coming online over the next 12 months. That underscores the volume growth. Number 2, innovation next year. We expect new platforms launching after the first of the year in January and then next summer. Has not been disclosed yet. We believe one is a plant protein shake, which could drive a new opportunity for growth in the category there. And then inorganically, looking at opportunities for partnerships to build distribution with beverage companies going to the convenience store channel, even potential for a takeout.
I want to stop on that point because that was interesting. Some colleagues on the street I know, they mentioned this name as a potential takeout target. You agree with that?
We do. This is a category where you've seen about 15 acquisitions take place just since 2019. Growth is at a premium in consumer staples overall. This is a very differentiated category, and Premier Protein is one of these brands that has the unique appeal to lifestyle consumers. So we believe there's a lot of value in this business and in this category.
All right, before you pile in though, you're listening to this, John. Maybe, and the viewers, John makes a good point, but what are some of the risks you got to think about, John, with this one?
The main risk right now, we're seeing this almost every day in earnings season, is the weak consumer. You're looking at most of the consumers in this category in that $50,000 to $100,000 household income, around the median for U.S. consumers. So there is risk you could see some softening in the category. That being said, we believe the downside is limited because this is moving to more of a staple consumption occasion as opposed to a discretionary consumption occasion. And not only that, but the increase in distribution for BellRing should support continued volume growth even if the category does soften.
All right, so that's one you like. Let's move to one you would avoid, John. Here's a name, listen, a lot of people know it, Beyond Meat. Let's go through the points there. The first reason, John, you would say weakening plant-based meat category. We got a chart on this one. Walk us through this one.
Yeah, Josh. So the category's been soft. You're 45 consecutive months now of volume contraction for the category. The rate is improving. However, we really don't see a real inflection for growth back to the category level over the next 6 to 12 months. That's number 1. Number 2, Beyond Meat continues to lose share. There's been some excitement over this new Beyond Meat 4 platform with ingredients reformulation that reduce the saturated fat content. They have some accolades now from the Heart Association, the Diabetes Association. That being said, we believe it takes more than just the nutritional content. You have to have more innovation, different subcategories, convenient options, frozen meals to really drive penetration for this category. So that's a headwind. Then number 2,
let's go through it. Second point, market share is declining.
That's the market share issue that we see right now, and that's exacerbated by the pricing decisions. Cash flow, you're seeing cash burn, about $70 million annualized here in Q2. In order to cut that as volumes are declining, Beyond's raising prices. They're raising prices 10, 12, 13% into a weak category. The rest of the category is lowering prices. The price gaps are expanding, and that continues to pressure market share, which is down 2 points year on year and about 6 points below the high back in the summer of 2020.
Final point here, a capital raise remains likely in your opinion.
That's right, and this ties back to the cash burn we're seeing in the company. $70 million annualized run rate for cash burn. We don't think they turn cash positive until late 2025. There's $150 million of cash in the balance sheet exiting Q2. We believe there is a real risk of a capital raise here in the next couple of months, which could be materially dilutive for equity holders.
And you know, this stock's been hit so hard already, John. You don't think a lot of this is already priced in?
You know, it's funny. I mean, just given the valuation it had post IPO, it still trades at about 4.5 times revenue right now, which is double what a packaged food company trades. So I mean, you're still putting more of a tech multiple on this company.
All right. So what are the risks you got to think about though for viewers?
Well, I mean, the risk would be an unexpected turnaround for the category, or for Beyond Meat, getting greater traction from this new ingredient reformulation. It's hard to see because you've got a 10% reduction in outlets sold year on year for Beyond Meat globally, so you're not really seeing the flow through on the outlet side or on the repeat or trial side. But the biggest issue would be just expectations being very low and seeing a return to growth sooner than we think.
All right, to wrap this up, John, for viewers, you got to buy on BellRing. You would say avoid Beyond Meat.
Yes.
John, thank you so much for your time and those picks. Appreciate it.